Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. European tech players report, including Nokia and ST Micro. Stateside Alphabet shares slide overnight as it says Capex will likely top an unprecedented $200 billion this year. Meanwhile, oil gains after Houthi attacks on two tankers in the Red Sea threaten a new front in the Iran war. And the ECB grapples with inflation fears ahead of today's rate decision. Investors watching for any signals of a move higher in September. Well, a very good morning. Here's the picture in markets this Thursday. Just a snapshot, but a contrast between East and West. We've got shares higher in Asia, fueled by the chipmakers on expectations that they're going to benefit from AI spending. Brent has been higher again after the Houthis attacked two tankers in the Red Sea. And if we look over to the right of this board, we have the 30-year yield still sticky. The Treasury yield at 5.14, so holding above that crucial 5% level. It's been above that level for the longest streak now since the dawn of the financial crisis. So that is concerning, of course, also pushed higher by concerns about America's growing debt pile. Plenty to bring you. Lots of earnings this morning. Let's set you up for the day ahead. Well, we begin with breaking earnings out of France. The bank, BNP Paribas, the expectation had been that its investment bank would be one of the key earnings drivers. Clearly, the market volatility of the past quarter has been the backdrop for banks. The question is whether EU banks like BNP will ever be able to benefit from that volatility to the extent of US banks. What we are seeing is the redhead second quarter net income coming in at 4.35 billion euros. The estimate was for 4.23 billion euros. So, indeed, it is a beat there for BNP Paribas. And if we look into a little more detail of what we're seeing here, BNP reporting not only better than expected profit, but also revenue. Stock traders blowing past estimates here. So equities revenue rising 43% from a year earlier to 1.4 billion euros. And that's maybe a little shy of the gains reported by some of the biggest Wall Street firms, as I say, but it's well ahead of the 1.1 billion euros forecast by analysts. So we're going to be speaking to the CFO, Lars Machenil, on the opening trade later this morning. That conversation coming up at 7:15 a.m. London time. Also going to be really interesting to get an update on its Sudan litigation, if we can, and indeed Lars's views on the future of European banking consolidation. Well, that, of course, is also a theme for UniCredit, and their earnings out of Milan dropping as well. So let's switch to that. Second quarter net income coming in at 2.91 billion euros. The estimate was for 2.8 billion euros, so a beat there. Analysts were expecting upgrades to the guidance. We've seen the shares up 44% in the past 12 months. Well, they say that the full year is well above, for net, 11 billion euros. They saw equal or above that level. So they're raising their goals as the CEO pursues this Commerzbank deal. And this is Andrea Orcel moving closer, really, to the takeover of Commerzbank. So upgrading that full-year profit guidance and lifting also the mid-term profit targets as well. Remember, of course, just a few weeks ago, they completed the takeover offer for Commerzbank. So that putting Orcel on track to control close to 50% of the bank, and the full taker would mark the biggest bank deal in about 2 decades. So really interesting to see these numbers out of UniCredit. We also need to switch over to the tech space because we have results from Nokia as well. They're coming in thick and fast, these earnings this morning. So let's switch over there. The redhead crossing the terminal, that second quarter adjusted operating profits at 434 million euros. So a big beat here. The estimate was for 372.3 million euros. The CEO saying they're still tracking somewhat above the midpoint of the guidance. Operationally, the full-year outlook is unchanged, they say. So this was expected to profit from the optical cable business, which, of course, sells components to the data center industry. Last week, we had rival Ericsson revealing that margins would be under pressure in Q3 from higher prices as that data center construction boom constrains the memory chip supply. But a big beat here when it comes to adjusted operating profit from Nokia, so a little brighter. We also, just staying in European tech, have results from ST Micro, and they say that data center revenue is going to be well above $2 billion in 2027. In 2026, it's above $1 billion. They've raised their revenue ambition for data centers. And the redhead is that they see third quarter net revenue at $3.7 billion, which is just shy of the estimate, actually, of 3.79 billion euros. So a slight disappointment there, actually, for ST Micro, but the chip maker largely benefiting from strong AI data center demand, as we see from Nokia as well. Well, let's get some analysis now. We can bring in Matt Bloxham, tech analyst here at Bloomberg Intelligence. Matt, I've just run us through the numbers, the top lines, but what stands out to you for ST Micro and Nokia, first of all?
Yeah, I think with ST Micro, maybe there's that kind of little bit of margin softness, which maybe is to be expected given there's just so much inflationary pressure on components into these things. But yeah, an optimistic outlook for the data center opportunity, and also that comes through in Nokia, as you mentioned. Both those companies are kind of peripheral plays, if you like, on the whole AI data center boom. Nokia's invested heavily in a particular company called Infinera, very much in the kind of optics part of data centers. Similar story for ST Micro, and I think when you look at the big picture and the kind of revenue opportunity, they're both talking optimistically about their opportunity there. But yeah, some pressure still on profitability, because even though perhaps the revenue opportunity is looking better, both of them perhaps a little bit soft on the profit side, and that's definitely been an ongoing concern. As you said, we saw this with Ericsson last week, that input costs are a problem for them to manage, and it's constraining the profit outlook to some degree.
Well, you talk about Europe, these companies kind of being on the periphery or maybe further down the supply chain. The boost that we're seeing in Asian stocks this morning follows the results that we saw for the mega caps yesterday. They're maybe in Asia looking to benefit from this Capex, but the Capex sort of worrying for some of these mega cap players. So if we start off with Alphabet, first of all, doubling down, lifting spending outlook, but that's concerning, it seems, to investors.
Yeah, it is, and I think it's concerning because although the top line print was a bit better than expected, it's only about 1% or so better, so just about $103 billion of revenue in the quarter, and actually the profitability on the services side was a little bit weak. Better on the cloud services side. So I think although the business is still growing north of 20% year on year, it's been growing at those levels for quite some time without these massive capital expenditure spikes. So I think the market's looking to see more to kind of balance against the Capex spend, and it's pushing the Capex spend very much into the kind of speculative territory, in that we've been in an AI arms race for quite some time, and that's just getting even bigger, and you start to get this kind of irrational spend coming through. And I mean, it's a few years back, but I can remember Mark Zuckerberg talking about we don't know whether we're going to make any payback on these investments, but we kind of have to do it, because if we don't do it, we're not in the game anymore.
Well, yeah.
And it almost feels like we're kind of getting a little bit back to there, and I think that's what worries investors.
But you kind of wonder whether, if everybody's pumping money into Capex, surely the bigger worry would be if they weren't doing that. I just want to play you a bit of what Elon Musk said, because, of course, we also had Tesla results, but shares tumbling there, too, off the back of their results. And, again, Capex a concern for investors. So let's take a listen to what Elon had to say.
We should be spending on Capex as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time.
So why is that not reassuring, Matt, to investors?
A couple of things. I mean, for me personally, the fact that he even put wasteful in his kind of response is a question mark. It plays to this concern investors have. Why is any of this capex wasteful? I think, and there's quite a big difference, I think, between Tesla and a Google. As much as there's uncertainty about the opportunity facing Google, it's much clearer what the AI opportunity is for them. For Tesla, it's about humanoid robots. It's about robo-taxis, it's about self-driving cars. Some of that is kind of clear, but yeah, there's lots of question marks, particularly around the humanoid robots. So the capex for Tesla feels, for me at least, a lot more speculative than it is for Google. So I think that's a question mark. So the whole industry has a lot of questions still to answer about the return profile of these investments. And I don't think we've got yet any clearer answers about that from anybody that's reported so far.
A little more sci-fi, perhaps, when it comes to Tesla. Matt Bloxham, really appreciate your analysis. That's Matt Bloxham, tech analyst here at Bloomberg Intelligence. Well, those expectations for increased hyperscaler spending are boosting tech stocks, as I say, in Asia. We're looking at the MSCI Asia Pacific Index up nearly 1% this morning. Let's zoom in. We can speak to Winnie Su in Hong Kong. Winnie, what should we be watching this morning?
Yeah, good morning, Lizzie. As you just mentioned, it's quite interesting to see that divergence in terms of reaction towards Alphabet's earnings from the U.S. investors and here in Asia. Here, at least, as you just mentioned, it seems like it's more the excitement of how those massive spendings can potentially trickle down to the supply chains here in our region. For example, SK Hynix here, you can see up about 4%. And in fact, it is getting more than 7% of its sales from Alphabet. And also, we are seeing the gains in the Japanese equipment makers, which are likely also going to benefit from the more spending of the U.S. hyperscalers. But flip the board, we take a look at the broader Asia market because gains being led by tech. We are seeing MSCI Asia here up for a third session, its longest of such streak in about 3 weeks. Leading gains today, we have South Korea's Kospi here up more than 3%, seeing another day of foreign investors buying. Now, we are seeing foreign investors buying every single day so far this week, coming after net selling for the past 4 weeks. So that net inflow from investors are actually boosting the South Korean won. Here is strengthening by 0.7%, outperforming all the other Asian peers. Also being supported by the better than expected GDP numbers that reinforce the bets on further rate hikes to come. Flip the board, we take a look at Japanese assets because still all eyes are on the Japanese yen, which is still trading above that 163 level against the dollar, around its weakest level in 4 decades. Yes, yesterday we did learn that the Bank of Japan is open to raising rates faster than what the consensus is expecting. And that expectation now for a more hawkish tilt from the Bank of Japan is also raising the 2-year yield here higher. We are seeing the curve flattening further while the 10-year yield is still slightly higher, tracking those moves from the treasuries overnight. Back to you, Lizzie.
Winnie, thank you very much. That's Bloomberg's Winnie Su. Well, to another corner of the market now, looking at Brent trading up 2.2% at $96 a barrel this morning. This as Yemen's Houthis say that they've targeted 2 oil tankers in the Red Sea after threatening to open another front in the Iran war. Now, the UK Maritime Trade Operations Centre reported that a ship has been on the Saudi Red Sea coast. And meanwhile, as the US completed a 12th straight night of attacks on Iran, President Trump posted on social media threatening to bomb 1 bridge or power plant for every time Iran shoots at a ship in the Strait of Hormuz. So let's unpack this with Bloomberg's Paul Wallace now. Paul, we've got 2 fronts here opening up. The war widening, it seems. How much does it reduce the chance that the US and Iran are not going to come back to the negotiating table?
Hi, Lizzie. Well, I think we can now say we do have a new front having opened on the Red Sea coast, because the Houthis a few days ago effectively threatened to attack ships in that part of the world, but they hadn't done so until these claims last night. We still have to get them confirmed. The UK MTO seems to have confirmed one of the attacks, but not the other. But nonetheless, this is a very worrying development for Saudi Arabia, for the US and its and its allies. And in terms of getting Iran and the US back to the table, it seems like it makes that even less likely. Iran and the US have really been signaling in the last few days that they're not ready for a new round of negotiations. Of course, we had the 12th night in a row of US strikes on Iran yesterday, and Iran continues to hit countries like Bahrain and Jordan and Kuwait, and also ships in the Straits of Hormuz. So at the moment, it seems as if the signs are pointing towards escalation rather than any easing of tensions.
Yeah, and interesting to see the US and Saudi Arabia finalising their nuclear technology sharing deal. Surely that risks sparking a nuclear race in the Middle East when, the US is giving Saudi Arabia exactly what it went to war with Iran to prevent: enrichment. Paul, really good to get your take this morning. That's Bloomberg's Paul Wallace out of Dubai. Well, let's take a look at the risk events for the markets on the docket for today. At 1:15 p.m. London time, it is an ECB decision out of Frankfurt, a hold expected. But do we get more hawkish hints when it comes to a September hike? We should be discussing later on in the show. At 1:30 p.m. London time, it's US weekly jobless claims expected to stay about the same level as last week, despite some of the AI-driven changes in the labour market. And then we also have more earnings from SAP out of Germany, of course, the software company. The bar a bit lower for expectations given the AI worries, especially after that IBM profit warning earlier this month. But still ahead, the ECB, as I say, expected to hold rates this lunchtime, but traders waiting for clues on what happens in September. And speaking of central banks, first of all, how Kevin Warsh's lack of forward guidance has left traders scratching their heads, guessing the Fed's next move just a week before its next meeting. We'll get you all the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. 6:18 here in London. Well, the lack of forward guidance from the Fed has left traders guessing next week's rate move. Swaps markets suggesting that traders see a roughly 30% chance of a 25 basis point hike and a 70% chance of a hold. Now, that kind of split so close to a meeting has been exceedingly rare in recent years, but maybe it's going to be a bit more commonplace under Kevin Warsh as Fed chairman. Let's get some analysis now. We can bring in Ven Ram, cross-asset strategist at Bloomberg MLive. Ven, is this inevitable when you have a Fed chair who wants less forward guidance? What sort of positioning is going to be the result of this uncertainty?
Absolutely, Lizzie. I think it's a sign of things to come. Because if Warsh doesn't want to give forward guidance, I think this is the way the markets are going to price. And as you were mentioning, this is extremely rare. We haven't seen this kind of shift in pricing in the past 2 years, actually. So the markets are thinking, you know what, if you're positioned, depending on how you're positioned in the portfolio, you need to be hedging your bets. And the best way to hedge these bets, hedge the bets going into these Fed, is to buy the short-dated swaps. So if there is a surprise that the Fed throws a curveball, then the portfolio is adequately insulated against any unforeseen changes. And if you see what is happening in the MOVE index, that captures very well what is going on. And the market, VIX the MOVE index has pushed higher since Warsh took office. And if you look at the 2-year and the 10-year yield, they're also telling that where yields in the front end were trending lower than 4% before Warsh took office. We have seen 425 as the new equilibrium on the 2-year and 450 as the new equilibrium on the 10-year. And I think that's going to prevail because Warsh is talking very hawkish. And I think that the markets are increasingly going to be positioned for the risk that, the Fed will deliver something more hawkish than they had ever imagined.
Yeah, maybe we see a bit more volatility around the data taking on increased prominence, as well as the developments on the geopolitical front. Ven Ram, thank you very much. That's our cross-asset strategist at Bloomberg MLive. Well, coming up to M&A, Paramount's takeover of Warner Brothers wins conditional approval from the EU, but the deal could still be derailed by a US lawsuit. So we'll get you the details on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Paramount shares have risen in the US after its $110 billion takeover of Warner Brothers won conditional approval from the EU. The green light comes after both companies agreed to address competition concerns, but the merger still faces a US lawsuit that threatens its progress. Let's get some more detail now with Bloomberg's deals reporter Manuel Baigorri. Good morning, Manuel. So first of all, what did Paramount have to do to get this approval? And second, what's next when it comes to US legal hurdles and maybe even a possible UK public interest intervention when it comes to this deal?
Yes, Lizzie, we've seen this deal taking so many twists and turns, and now obviously after they got it announced, they need to get clearance from regulators. We knew from the beginning that it was going to be a very tricky and bumpy path ahead to get the clearance, and obviously, as we just learned just a few days ago, 12 states in the U.S., including California, they are suing this deal on grounds of competition, right? So that is the major hurdle that they will have to clear to get this through. Obviously, as we saw with the European Union, European Commission now getting a nod and clearing the deal, that is a major step. So it's definitely a good win for the companies, but at the same time, it's not enough. And we've seen a lot of deals actually getting stuck for very lengthy periods in Europe. That's not the case on this one, so that's definitely positive, but yet not enough. And we're seeing that also translating to the spread, the stock versus the actual bid and the agreement on the table between the companies. So that's widening as well with regards or reflecting those growing concerns. Again, I think we're going to see a lengthy period, especially out of the US. Whether or not the UK will weigh in as well remains to be seen, but obviously that will potentially be another hurdle to overcome.
OK, the saga continues. Manuel, thank you very much. That's Bloomberg's Manuel Baigorri. Now, to some other top stories we're following for you this morning. Bloomberg has learned that OpenAI's advanced AI models completed an attack in hours that would normally take a skilled hacker several weeks in the incident which breached the internal systems of AI startup Hugging Face. OpenAI said it notified law enforcement and other authorities and has been transparent about its findings. And elsewhere, European car sales have hit their highest since October 2023 as more drivers shift to electric vehicles. The European Automobile Manufacturers Association says sales rose 13.1% in June to 1.4 million units. Battery-powered vehicle sales rose 51%, with France and Germany making up the bulk of the rise after new incentives helped drive sales. And sticking with cars, Aston Martin has secured £550 million of fresh funding from BlackRock-owned HPS investment partners to strengthen its finances. The luxury car maker said the funding will help repay existing debt and lift its liquidity to about £340 million as of the end of June, as it grapples with challenges including product delays, quality problems, weak Chinese demand and US tariffs. What a list. Well, coming up on the programme, the ECB is expected to stay on hold today, but how do escalating tensions in the Middle East affect the outlook? We've got a keen eye on September, of course. That's our conversation next, so stay with us. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Bumper bank earnings as traders triumph at BNP Paribas. UniCredit raises its guidance for the year after higher than expected profit. Meanwhile, tech takes centre stage as Nokia posts an earnings beat as well, while the chip company ST Micro guides to revenue below expectations this quarter. Stateside, Alphabet shares slide overnight as it says Capex will likely top an unprecedented $200 billion this year. And oil gains after Houthi attacks on two tankers in the Red Sea threaten a new front in the Iran war. Well, this is the picture in markets this morning. Good morning if you're just joining us. 6:30 a.m. here in London. We've got Asian shares rising, fueled by the chip makers on expectations that they'll benefit from the AI spending that we've been discussing. Mag 7 earnings coming through last night. But today we have European and US futures pointing lower. Alphabet and Tesla dropping after earnings, and the S&P yesterday slumping for the fourth time in 5 days on the oil price jump. Now, speaking of which, flip the board cross asset, and you've got Brent up again, 1.6% higher this morning at 95.55 the barrel. That fueling concerns about sticky inflation. It's, of course, off the back of Houthis attacking 2 Saudi tankers in the Red Sea. If we look at the very long end of the curve, the 30-year yield's still above 5%, and it's held above that level for the longest streak now since the dawn of the financial crisis, also pushed higher by concerns about America's growing debt pile. And you've got the dollar a touch weaker this morning, down 0.2% on the Bloomberg Dollar Spot Index, despite, you might say, higher prices for oil. Now, let's turn to the front pages this morning. What do we got from the Financial Times? It's reporting on Google's gargantuan AI spending as free cash flow turned negative for the first time. The paper says it adds to investor anxiety about the scale of its bet on AI. Meanwhile, the Wall Street Journal reports on a surge in US forces to the Middle East. This paper saying that special operations forces have been deployed to the region, and bomber aircraft at bases in the US and the UK are on high alert. Finally, here in Europe, the headline on Les Echos out of France reads, why the confrontation between the United States and Iran is destined to escalate. It says the war risks spiralling out of control. You can get a roundup of all the stories you need to know to get your day going in today's edition of the Daybreak newsletter, which terminal subscribers can find by going to D8YB Go. Now, let's head to Frankfurt because the European Central Bank meets today, of course. It's widely expected to keep interest rates unchanged. And while the deceleration of euro area inflation in June eliminated the need for urgent action, the ECB is likely to leave the door open for a move in September. Let's go now to Jana Randau. She's outside the ECB for us in Frankfurt. Morning, Jana. So a hold expected, but how divided is the Governing Council? You speak to all of them. What have you been hearing from different members of the GC?
Good morning, Lizzie. It's good to be here. So there was a bit of a division earlier this month when the ECB had its forum in Sintra. We heard there that some were arguing, well, we definitely need to raise interest rates one more time in September just to make sure that inflation is coming back to the 2% target. Others were saying, well, maybe, with the ceasefire in place, maybe one in June is enough because in growth, will react and growth is slowing down. So that there was a bit of, a division there. That has changed now. Everybody's on the same page when it comes to this month, so no change expected. And as for September, as you know, the Greek governor put it a few days ago, it's back to square one, and that's of course because of the escalation in the Middle East of new fighting. New attacks, of oil prices going up, energy prices in general going up, and that of course means new inflation risks for the Eurozone. That slowdown in inflation we saw that was bigger than expected, that is now certainly going to be reversed. So yeah, really back to square one, looking at data, looking at fresh forecasts in September. That's what the ECB is really waiting for, and then we'll see.
Well, give us more of a flavour of the data then, the economic backdrop heading into this meeting.
Yeah, so inflation a bit weaker, growth surprisingly resilient. We saw PMIs that were essentially out of contraction, not quite growth, but right on the border between growth and contraction. That is good news. Sentiment indicators going up recently, but the big question, of course, is will that hold? And what's going to be interesting today is not so much the decision itself, of course, but how Lagarde really describes the economic outlook, how she describes the risk assessment, because what they're wondering, of course, is second round effects, inflation expectations. Inflation expectations we've seen going up in the short term, which is normal if you think that prices are higher today. But the medium term is important. They've trended higher, not so much concern from the ECB so far, but that can of course change. And then second round effects is really the enemy, if you want, for any central banker. And that's wage growth, of course, a lagging indicator. So if there is something to see there, that's probably going to happen later this year. So they're on alert. They're watching out. The data so far we've seen looks pretty good. But again, whether that holds, whether that remains to be true, very much depends on the situation in the Middle East. It's very fluid, as we all know. So not much of a commitment that we expect from the ECB today.
OK, Jana, really looking forward to your coverage throughout the day. I'm sure you'll be able to tease some clues out of Christine Lagarde at the press conference on what might be happening in September. That's Bloomberg's Jana Randau outside the ECB for us in Frankfurt. Well, let's get some analysis now. We can speak to Josie Anderson, European economist at Nomura. She joins me in studio. I want to start, Josie, with a quote from Christine Lagarde back in March. It's in your notes. The public may find it difficult to understand a reaction function that does not react. Well, Jana just said it out there. You've got re-escalating tensions in the Middle East. Oil, $95 the barrel. Does it make sense to you then if the ECB holds today?
Well, I think the ECB sees what is likely to be a hold, probably as a review period. They're not saying we did one hike and then one and done. They're saying we're watching how the data develops, and in September we'll have more forecasts. There's so much uncertainty. After the last meeting, it was almost that evening, the next day, we had news of a de-escalation in Iran, oil prices falling. They've done almost a perfect U since then, and they've come back up. So the ECB will actually probably be feeling the effects of that, where it produced forecasts that we thought were quite hawkish last time. But then almost immediately after that, everything was looking a bit more benign, and now they're in a more concerning situation. When she said that quote about reacting to its own reaction function, she also noted that its own forecasts included the assumption of 2 rate hikes. So at that point, we made it pretty clear their baseline was 2 hikes, but not necessarily in quick succession, over what we thought was likely to be a quarterly period. But at the last meeting, she left things a lot more open because of high uncertainty, and we imagine that she will want to do the same today. OK, because on the comms today, you've got 2 hikes already priced in by year end. It's surely going to be difficult for Lagarde to sound more hawkish than that. Are we going to come out of this meeting thinking, oh, that was a dovish hold? Well, yeah, exactly. We do think there's potential for that. We do see another hike in September. And then, of course, markets are pricing almost another one by December. But that December question, Lagarde, I think, will just be thinking that it all depends on what happens in Iran. And so she won't want to commit in any way to a December hike, even if she hints at September. And so we think there's potential to disappoint markets from that respect.
But you say ECB market pricing is largely an oil trade. If that's the case, and as I'll say again, oil at $95 a barrel today on Brent, why not go for 50 basis points in September?
Well, yeah, that is a good question, and one we have looked at, but we think it's unlikely. So the last time we saw some 50 basis point hikes, that, of course, was in a much bigger energy crisis in 2022, when we saw inflation rapidly accelerate. We're not yet in that scenario, and we don't think that ECB will want to signal that it's in a scenario where it needs to take an aggressive stance to get inflation back to target. We think Lagarde has set out 3 different scenarios, kind of a scenario that doesn't require a transitory inflation scenario, a scenario that would require a small adjustment. And we think she still likely views we're in that scenario, although rising oil prices do risk that we're in a third scenario that's a bit more like what happened in 2022, that requires a more aggressive hiking cycle. But at this point, we think a 50 basis point hike might signal that third scenario that she's not yet ready to say we're in.
OK, well, let's put our optimistic hats on and turn to the flip side of all of this. Let's say we have this meeting and then diplomacy resumes and oil falls. How low would it have to fall for how long to write a September hike off?
So we actually think September was always likely, even if that fall in oil prices that we saw after the last meeting had continued and oil had stayed roughly similar to prior to the start of the war this year, because, of course, we had that fairly lengthy duration of much higher oil prices between early March and June, and that will have already done some damage in terms of higher inflation expectations, energy prices feeding through slightly to the rest of the economy. And so we think the ECB would have always likely hiked in September just as a signal and to manage any potential second round inflation effects, particularly because actually the ECB said recently that what it regards as neutral policy rates, and so one that doesn't place upwards pressure or downwards pressure on economic growth and inflation, is likely between 1.75 and 2.5%. So another hike to 2.5% would still be broadly neutral at things, so not even particularly restrictive.
So can you split how much the further hike or hikes you see would be because of, on the one hand, the oil price, and on the other hand, the second round effects?
Yeah, so, I mean, obviously they're very interlinked, right? Higher oil is for a longer duration, the more that will feed into people's inflation expectations, therefore wage negotiations and second round effects. And this is all really the ECB can work against in its policy rate, because it can't stop wholesale energy prices rising and households' energy bills and pump prices.
The Strait of Hormuz.
It can't affect them. Fiscal policy might be able to affect things like pump prices with tax changes, but the ECB can't. So what it can act against is second round inflation effects, kind of putting a bit of the brake on the economy. They haven't slammed it down, but they're putting the brake on slightly just to say, hey, we're seeing the potential for second round effects. We don't want them. We will raise rates to work against the potential for that.
OK, Josie, always a pleasure to have you in the studio with us. Josie Anderson there, European economist at Nomura, ahead of today's ECB decision. Well, coming up, stock traders blow past estimates at France's biggest bank. We're going to unpack the numbers from BNP Paribas next. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:45 a.m. here in London. And at the start of European cash trade, of course, we'll have a very keen eye on BNP Paribas. This morning, it's reported better than expected revenue and profit for the second quarter as its stock traders blew past analysts' estimates. Equities revenue at the biggest French bank rose 43% from a year earlier. And we get analysis now with Claudia Cohen, who's been across all the details for us. So, Claudia, good morning to you. What stood out to you from these numbers?
Morning. Thank you so much for having me this morning. So obviously you mentioned it, the equity trading performance is really spectacular for BNP. BNP is one of the first European banks with publishing earnings. So we can see with BNP that European banks are actually following the Wall Street euphoria with the volatility, the technology, obviously stocks that were extremely high those past few months. So this is one point. And to one other point on equity also, the size of BNP equity trading revenue is as big as its FIC revenue, while FIC usually is way bigger. So this is one important point. Then you mentioned it also, the net income and the revenue are beating estimates. So this is one point also. And the main one I think that analysts were really looking for is the CET1 ratio. So BNP CEO Jean-Laurent Bonnafé said that the CET1 ratio would be at 13% in 2027, and BNP succeeded to achieve this level for this quarter, and analysts were really looking for that. And if we look a bit at the downside, maybe because they are slightly downside, cost of risk was a bit higher than expected. The bank took some provision because of the geopolitical context, and then cost also, the operating expenses were slightly higher also than expected.
OK, so impressive set of numbers for BNP. I do want to rub it in after the World Cup defeat for France to England, Claudia. But you've got a great story on the terminal this morning about why there might be an exodus of bankers from France, which is a bit of a reversal from the post-Brexit situation. Tell us more.
Yeah, so thank you so much for highlighting the story. So we're not there yet. We're not at the Exodus, of course. The story is about bankers who came to Paris following the Brexit referendum. So for some of the US banks, if we name, for example, Bank of America, the first bankers post-Brexit who came to Paris, they came around 2018, 2019. And basically in France, as in many other countries, there is this marvelous tax program. Basically, if you're wealthy bankers and you come to Paris, you have less taxes than you will usually have. So, and this is an 8-year deal. So the 8-year deal is going to expire from this year, next year, and obviously like the following years. So the story is about, you know, if you're a banker, you work in a French banks or US banks, you're a British banker, you came all the way from London, are you going to stay in Paris if you're going to pay around, you know, 15 to 25% more taxes? So this is what the story is about. All those bankers asking themselves, you know, what I'm going to do next. I would say it's either a personal story, because obviously, you know, after spending 8 years in a country that maybe is not yours originally, you want to, you know, maybe it's time for a change. It's a personal story also because, you know, all those bankers, like they pretty much love Paris. Some have kids in school, so it's not that easy to move. And also we highlighted in the story, it's about politics, you know, because I guess you noticed, Lizzie, but politics is a bit messy those past few months in France. And next year we'll have the presidential election coming. You're seeing obviously the far right leading the poll with Marine Le Pen, who is not seeing as such, you know, a pro-business candidate, and the far left also, which is having a momentum. So obviously the political context is waiting on the bankers' decision. That said, if I can add one more thing, talking with management at those US banks, either those French banks, no one is really expecting an exodus. First, because Paris has been very attractive, a very hot scene for M&A from trading desk. And then the second question, I guess, Lizzie, is like, okay, we said that Paris has been a bit messy, but everywhere else is messy, you know. So if you leave Paris, where are you going to go? If you look at London, you know, you had some of your political problem also. And even if you look at Milan, which has been very attractive for those high earners incomes, we never know. There might be a governmental change. So my story is about all those bankers asking questions, and I guess we'll see in the coming years and from next year if they take a decision to move or not.
Yeah, let's see whether the new Prime Minister Andy Burnham here in the UK takes the opportunity to attract those bankers back to London. Of course, we had Jamie Dimon, the JP Morgan CEO, warning, you know, that UK bank tax surcharge could drive capital away. Is Burnham listening is a big question. Claudia, great to get your reporting. That fabulous story. It's on the terminal. I highly recommend it. Claudia Cohen, thank you very much. And also, don't miss our interview with the BNP Paribas CFO, Lars Machenil. That coming in just a few minutes, 7:15 a.m. London time. Now, to some of the top stories we're following for you this morning. The UK Prime Minister Andy Burnham has announced a 20% reduction in business rates for hospitality, the cut applying to pubs, clubs and live music venues from April next year. The government says the measure will be fully funded, with reliefs for what it calls antisocial businesses, such as vape shops, being reviewed. Elsewhere, EasyJet shares slumped after Reuters reported that the EU is preparing to review airline ownership rules, a move that the report says might affect takeover bids for the low-cost carrier from US investment firms Castlelake and Apollo. EasyJet's due to report earnings at 7 a.m. London time. Well, we've got plenty more coming up on the programme. Don't go anywhere. This is Bloomberg. Good morning from London.
We remain open to diplomacy. We remain open to working it out in a negotiated way. But right now, they don't seem to be serious about that. And so we're going to continue to protect shipping. At the same time, we are going to, when the opportunity presents itself, degrade their ability to target global shipping.
US Secretary of State Marco Rubio there speaking in Manila. And as you can see, as the war has widened on two fronts now, we've seen traffic slowing through the Strait of Hormuz. There was a window where traffic picked up when that ceasefire was implemented, but that ceasefire now seems shot to bits. Now, let's take a look at the impact on the bond market, because as we've seen oil climbing towards $100 a barrel again, it's really been the front end of the US yield curve that's been bearing the brunt of the oil shock. And yes, you've had Fed Chairman Kevin Warsh giving that steady messaging. That's doing a lot of the heavy lifting when it comes to anchoring inflation expectations, but it's the bond market that seems to be slowly starting to disagree. Now, will consumers catch up? Flip the board one more time, because actually we've seen pump price relief fading back at that crucial level, above that crucial psychological level of $4. And actually, for 8 days now, gas prices have been on the rise. So is this going to put pressure on President Trump to get back to the negotiating table? Rubio saying that they are open for talks, but can they actually work something out? Again, is a big question. A year of the midterms, this, of course, matters hugely politically. Let's take a look at some of the other risk events on the docket for today. We've been discussing with Jana Randau. We've got the ECB decision at 1:15 p.m. London time out of Frankfurt, followed 15 minutes later by US jobless claims. Their data taking more prominence given the lack of forward guidance, as we heard from Ben Ram. And then yet more earnings. We've already had a deluge out today, but SAP reporting earnings as well in the tech space. Speaking of earnings, the Valeo CEO Christophe Périllat will be joining the opening trade to talk earnings. That conversation coming at 7:30 a.m. London time on the opening trade. Anna Guy and Tom will take you all the way to the market open. This is Bloomberg.